Welcome to the Garfunkel Wild Healthcare Conference. This segment is on emerging trends in healthcare financing. I'm Andrew Schulson. I'm a partner director at Garfunkel Wild. I'm the chair of the Finance and Banking Practice Group and the co-chair of the Long-Term Care Transaction Group. I'm delighted to have with us today Elizabeth Butler, who's the National President of Healthcare Banking at Valley National Bank and is responsible for overseeing all healthcare banking for Valley National Bank, and Erik Lindenauer, President of FHA for NewPoint Real Estate and oversees the FHA multifamily and healthcare origination and servicing operations. Welcome.
Thank
Uh,
you.
if there is anything else you both would like to say in terms of the things that you do, please feel free, or else we can jump right into it.
Let's do this.
So the first question is, before people go to Valley for a bridge loan, and then Erik will go to you next in getting ready to submit an application to HUD. What do you look at in terms of being ready for financing? In terms of, do you look at EBITDA? Do you look at liquidity? Liz, what do you look for in terms of financing?
I think first of all, your experience in the market is the first thing I look at and your expertise. I think people discount it, especially if people are coming in as investors rather than it's their primary business. But the most important thing you can do is have a complete package, inclusive of liquidity, your cash flows, your market experience, and what your action plan is if you're doing a turnaround. At our institution, we do turnarounds and the assumptions that you're making on the acquisition to be successful. And then that's a great jumping off point for us to start a conversation.
Okay, then Erik, in terms of going to HUD in the application, in terms of seasoning, in terms, what do you look for, and in terms of timing and financials?
Well, first of all, the borrower needs to know what their ask is and needs to be organized. We need typically a trailing 12 months. We want to know if there was a recent cash out or not. If there was, we're going to be, we have two options. You could either have it has to have seasoned for 2 years, or we could do a lower leverage loan as long as we have 3 years of stabilized numbers. We also look at experience. We need 3 years minimum, kind of in the state, and obviously some strong NOI. But really, the thing that gets people hung up the most is around eligible debt.
Okay, and the debt that, when you look at eligible debt from a HUD purpose, I know that, most people come and say, okay, we have a real estate entity that's the borrower under a bridge loan. We're going to take the debt and go to HUD. What else would be eligible to go to HUD?
Well, first of all, we look at both the propco and the opco, but we actually underwrite only from the operator side. The rent payment has to just be, and we'll get into this a bit later, I think, it's a minimum, it's de minimis amount, needs to cover the debt service and the escrows at a 105. But we're really just looking at the EBITDA. And we obviously, when management is allowed, we underwrite for a management fee, and we also impute replacement reserves.
But as you just mentioned, Liz, the debt service in a lease, for HUD purposes, it's minimal. But what about from a bank's perspective? Because a bank, when they're doing their underwriting process, is not going to have the same standards as HUD and has an increased requirement. How do you look at the rent and debt service?
So I think for HUD, I think when Erik would agree with me, when you're underwriting a package, you underwrite to 145. We typically do as well. If we're looking at medical groups, we do a lot of different kinds of healthcare. We might be looking at a 125, but a 105 would not be considered to be eligible. It would be a criticized loan in a bank today. So
Right. That right. Of course, we also use a minimum of a 145,
yeah,
but that is just by law what has to be in the documents.
right.
Right, and Erik,
So I just didn't want to have a bunch of people lined up for you and I, Erik, to say, okay,
No.
we're going to get 105 and we're going to be in business, right?
Right, exactly. No, you're right, 100%. And frankly, if a nursing home is underwriting at a 145, there's got to be when you're ready to go to HUD, there's got to be a problem because of where HUD rates are. We're seeing deals still underwriting the 2.0 coverage range.
And you mentioned, Eric, that you look at the OPCO as well. Typically when you do a bridge loan, a lot of times there'll be a line of credit that's provided by the bridge lender. When you go to HUD, how does HUD view lines of credit?
They're okay with it, but they want to make sure that you have a qualified AR lender such as Valley and Liz and an experienced, they're not going to go with ABC Bank, right? And we do look at, because they want to make sure that whoever they do the intercreditor agreement with and the DACA and the DIASA, that is with a legitimate bank that knows what they're doing, that can actually monitor cash and really help the borrower navigate their receivables.
And in terms, so that's on the line of credit side, but in terms of, let's say, Liz, you have a borrower that comes to you and says, I want to do acquisition financing, but I also have construction needs. How do you typically handle their construction needs? And then Erik will go to you and say, how does HUD view it as well?
I think, look, we do soup to nuts financing. So for us, it's all about structure, right? You're going to give a longer IO period if you're doing actually construction, depending on the nature of it, if it's ground up or it's just improvement. We also will, account for beds being offline, while the improvements are going on. We're going to probably require a little bit more equity on a construction loan versus a stabilized transaction. And all of those expenses are usually we will roll them into our project costs as a total project cost, and then we'll do a percentage of that, depending on the borrower and the location.
Right. And where it becomes problematic is if you have a bridge loan, it goes to HUD, you've refinanced it with HUD, then the problem becomes how do you get financing for construction, because HUD typically won't allow the borrower to do construction financing after the fact, correct, Erik?
Well, they have something called a 241 program, which allows for improvements as long as it's going to increase the profits. But that it's still a difficult process to get through and time consuming. We recommend that all borrowers kind of do all of their kind of renovations and so on beforehand. HUD will allow, it used to be up to 15% of the appraised value that we could add on for improvements, so long as it's not major systems like plumbing and electrical, or HUD has this requirement that if you have more than two major components, then it falls into you have to do then a 241 or a substantial rehab loan. So, but if you're redoing rooms, hallways, nurses' stations, things like that, you can build up to 15% of the loan amount of the appraised value into the loan.
And for those people out there that aren't familiar with the 241 is a supplemental loan given by HUD after you've had your original loan. So that's the terminology that Erik is using when he refers to a 241 loan.
I think it's also important to note that on a lot of times you can get a term loan without taking a lien on it, maybe to do some, unless you're doing a major overhaul, to Erik's point, you can get a term loan to do wings, flooring, soft renovations, I call them, but that can actually be sizable sometimes in dollar amount.
And Liz, how do you look at it when a borrower comes to you and says, I'm going to buy a nursing home in XYZ state, but I've never operated there before. How does that look to the bank? And Erik, will follow up with you, how does HUD view it?
I look at it as less favorable. Look, we have borrowers that have facilities across the country and they do well. But I think for the first time you're entering an estate, you want to have boots on the ground that have experience in that market, because all things are different. New York is a CON state, Florida is not. The way that reimbursements are calculated is different from state to state. So having experience in the specific market is paramount to having a successful process at a bank.
I would also assume that a lot depends on who your operator is. If you've had an operator that's been operating with nursing homes for 2 months, no matter what state, versus somebody that's been doing it for an eternity.
100%. So for me, 2 months doesn't work, I would imagine. I'm in alignment with HUD. I try to look at like around 5 years of experience, but for younger people coming in, a lot of times we're able to marry somebody that's more experienced with somebody that's younger in a transaction, and it's a successful win for both parties, right?
And Eric, from a HUD perspective?
Typically, they like to see 3 years of experience. And like Liz said, a lot of these younger guys, maybe they only have 1 or 2 years of experience, and they'll partner with somebody who has local experience. And, somehow once they hit that 3-year mark, they'll do some sort of dissolving of that partnership and have a financial arrangement.
Wait, when you say 3 years, are you talking about having a member of the operations entity that's been doing it for 3 years? Or can somebody say, hey, listen, I found this administrator that's been an administrator in that state for 30 years. We're going to use him as the administrator. Does that work for HUD purposes?
It's really more of an art than a science. It's how you navigate that. I would say if we had an administrator who'd been there for a long time, that would be very favorable. But, the issue is that the administrator can go get a job across the street.
Right.
And so they really like some ownership, at least a very small percentage of the operator to have that experience. And usually if in a case like this, an operator wants to get into a state and wants to utilize HUD, they'll give him some ownership or her some ownership in the operations, a small amount.
So when you say, it's how you navigate it, that's when somebody should reach out to NewPoint and hire Erik Lindenauer, because Erik Lindenauer knows how to navigate that system.
With of course Garfunkel Wild as their lawyer and Liz as the bridge lender.
Right. I feel like
I
this
was
is
going to say, Andrew, I know that's my recommendation. Go ahead.
I feel like we should say, and right now, this was a public service announcement.
Right.
I was going to say that from a person that has limited ownership experience, it's not the same kind of experience. I agree with Erik. It's quite a difference to work for somebody else that has deep pockets with years of expertise and a great back office when you're going out on your own. It's a very different experience.
Yeah, and listen, as Liz knows, and we both agree, in this space, it's more important on who you lend to than the asset that you're actually lending on. And so, we know the good players in the space. We know the stronger operators. We know the ones that are getting into new states that are going to succeed. We also know the ones that have been in the same state, and it's going to be the same story all over again. But it's really, and then also good operators know how to manage their lenders and stay ahead when there's an issue or potential issue. And that's really important in this partnership between lender and borrower.
Okay, and we'll go into that a little bit more later. But, before we go into the loans, how is Valley National Bank viewing healthcare in general? And then Erik will ask you the same question. Does HUD have any reluctance in making loans to healthcare facilities based off of all the discussions we see out there in terms of litigation against nursing homes, in terms of increased Medicare and Medicaid rates? How does Valley look at the healthcare space?
In the long-term care market, we're extremely bullish. You think that by 2030, I think they're talking about we're going to be at the strongest peak for citizens hitting 80 years of age, which is great news for us. And in fact, they're talking about a shortage in the space. So for me, I think it's proven to be anti-recessionary. So some social programs, that's where it tends to win. But long-term care, people are always going to need a place to take care of the elderly where they can't take care of them at home. So we're very, very bullish on the space.
And not only that, but you look at the healthcare space versus the multifamily space. Everyone would have said multifamily was wildly safer. The problem is multifamily started going from a 5 cap down to a 4 cap down to 3 caps. the margins were so tight, rates go up a teeny bit, and all of a sudden you're underwater. Nursing homes historically have been in the 12 to 14% cap rates, and they could absorb a 100 basis point rate increase, right? And they were able to, the federal government and states were very good during COVID with the PPI and the other subsidies, and really allowed them to stay afloat. So, and in terms of the default rates, HUD has a very low default rate. I think it was like 0.5% overall their whole portfolio, maybe 1% on the healthcare side versus our multifamily side, which is much higher now.
And I would agree that you would even see between assisted living and skilled nursing that skilled fared much better due to the cap rates because they were able to absorb the variation in interest rates, and it's really been designated as a must-have, service for. That's how we take care of our elderly here in this country.
A lot of states now, there's wild fluctuations in the rates that are being paid for Medicare and Medicaid beds. You have states that are lowering the rates, you have states that are raising the rates, you have states that are silent. In terms of how does Valley and NewPoint look at this from a financing perspective in terms of allowing people to refinance and cash out? Just your little bit about your thoughts on how lenders look at these increased and decreased rates.
I think it's seasoning, right? So, when I get a phone call that says, "Hey, I've gotten this rate and I've had it for a whole 30 days. And I want you to do a pro forma for the next, 24 months. And by the way, before we've even hit it, I want to take all the cash out." That's a little bit more problematic as opposed to people that have been in a building, working it, improving the cash flow, and taking the benefit of all of their hard work and the improved economics.
Yeah, I agree with that. When you have someone that's been in the building for a long time, they've worked there, they've worked very hard to achieve better results. Much easier to digest than, somebody who moves in and all of a sudden they get a huge rate increase. And you have to be careful, like Florida, for example. Everyone was cheering in Florida that they had a Medicaid rate increase, which was really an incentive payment. And the potential, it could be a one-time payment, right? So you can't necessarily just use that increase and keep that for, as set in gospel or set in stone for the next couple of years. HUD will, generally consider an increased Medicaid rate, but they want to see, we have to have that rate in place for 3 to 6 months before they'll really kind of accept it and use that in the numbers moving forward.
How does both Valley National Bank and NewPoint look at it when you have a state that says they're coming out with rates, but they're delayed? So, for example, if you're going for a bridge loan and you're in a state where they say, "Oh, we're going to announce the rates," and it's silent, how does Valley react to that?
I'm not lending on cash flow on things to come. We can anticipate it. I think it's more of if you're dealing with the lender that's experienced on a national footprint or a regional footprint that's familiar with the local economics. Whereas if somebody's missing a covenant or something in that nature, and that an increase is coming, it'll put them back in. It makes it a little easier for that. But do I think I'm going to proactively lend on a potential 3% raise that's been 3 months late? 3%, probably not,
No. And
Yeah.
Erik, will HUD look at that and say, "Hey, rates have to be in place for a certain period of time"? How do they look at it?
So we actually need the physical rate letter.
Yep.
Know that it's real. Accountants can say things, borrowers can say things, but funny things happen in this world. And typically, like I said before, we want to see that rate in place for 3 to 6 months.
It has to translate, Andrew, just for one final point. It has to translate into value also when we're lending. And an appraiser is not going to give you the benefit of the rate without a rate sheet, as Eric just indicated.
When, I mean,
And then also, there's one more thing, you also have to offset that with expenses too, right? Expenses are going up every year. We have inflation, so it's not just a full pickup only on the rate side.
great. And we mentioned a little bit before, Liz, there's a lot of litigation going on in various states. We know there's a lot going on in New York against nursing homes. How does Valley look at these cases where, they're kind of percolating in the courts, nothing substantive has come about from them? And then, Erik, the same question for you from a HUD perspective.
I think, look, we have to take it on an individual case by case basis. We are very entrenched in a lot of the markets that are going on. We're looking back. We're looking at something that goes back to COVID that's been since resolved. Is it an active care issue? Then I don't think anybody is going to be, wanting to prioritize that as a client for us. But I think most instances it can be something as minor as the light being out over an exit sign. I think it really depends on what the case is and what's the level of fines that are being assessed.
Erik, same question for you.
So if a operator or a borrower is in litigation, active litigation with a state or the federal government, like the Department of Justice, for Medicaid fraud, Medicare, Medicaid fraud, quality of care, especially in New York, HUD wants either that resolved and settled, or to know that a settlement is imminent and coming out shortly, right? But if you're in the middle of a lawsuit, and we know plenty of borrowers who are, HUD will not proceed with them until those lawsuits kind of have some clarity around them.
And that's an interesting point, Liz. And let me come back to you on this. You're a bridge lender, right?
Yep.
You make term loans, but the primary is you make bridge lending on healthcare facilities to be taken out by HUD. Knowing that HUD will not allow you to submit your application and get a commitment until these litigations are taken care of, how does that affect your willingness to make loans when they're out there? Knowing that it may take some time for those.
No doubt about it, it makes it much more difficult, but on a case by case basis, if we think there's a resolution in sight, if we don't think it's going in the next couple of years and there's been active negotiations, we know that somebody operates 20 other facilities very well in the same market, it stands to reason you're probably going to come to some kind of settlement. If every single one of your facilities is rated a 1 and you're in litigation over half of them, you're probably not for us, right? Like that's the difference, right?
Yeah, and when you're structuring, I'll go to New York, and there are some other states as well in a second, but when you're structuring, Valley National Bank typically takes personal guarantees.
We do.
On them. Erik, from a HUD perspective, they don't have personal guarantees. How do they determine whether or not a key person or principal will be included or not?
Included in what specifically?
Typically in the regulatory agreement, there'll be a provision that says.
Yeah, so typically, if you own more than 25%, you are by default considered a key principal or managing member. Or you could own 1%, but your partnership or your LLC makes you the managing member.
Right. So back to the other thing I was just talking about. In some states, it's incredibly difficult to, like New York, where somebody wants to close on a transaction. You have a seller of a nursing home that wants to get out as quickly as possible. So a lot of times you'll see the acquisition of real estate and operations at a further time. It could take years before that happens. Liz, how do you look at that when your borrower is not technically going to own the operations? They may be running it pursuant to some type of employment agreement or administrative services agreement, but knowing that the actual operations will not be owned to a further date. And sometimes when that takes a long time, Erik, it could impact your HUD application. How do both HUD and Valley National Bank look at that?
Well, I think, look, in New York, we don't think it's happening before 18 months typically. I mean, at least historically in the last 4 to 5 years. Even Florida, I would say, is up to about a year. New Jersey is much quicker. So I think, again, understanding if you're in a state that it goes quickly and it's taking a long time, there's a problem. If it's 18 months, that's the norm in your state. I think also I usually like to get the memberships pledged. If somebody's being paid off for their assets in my transaction, I'm getting all those assets in part of the structure for my transaction. And they have full control over management and all of the profits, for who we're financing.
And Andrew, we've worked on a lot of transactions together, and typically what will happen is, we close on a propco very easily, and when the operator, we close on whoever the existing license is under, and that group, we underwrite the operations of that group. And typically I recommend, and you do too, is especially in places like New York, that they become a partner in the operations, like under 10% in New York, subject to DOH approval, which is pretty automatic most of the time. And then we also recommend that they become the CEO of that operator and hire as a CEO, and then once we close on the HUD loan, and then they get approval for the state approves a new operator who really wants to be the ownership. We actually have to do a TPA, or transfer of physical assets, all those in operations. And we have to just update documents and resubmit them to HUD. And a prudent HUD lender will underwrite the new operator, the incoming operator, as part of the HUD application now, even though we don't have a state approval, so that it just makes it easier. We kind of get a pre-approval or a sneak peek behind the curtain for when it's time to submit the final TPA.
Great. Couple of last questions. I know we're running up on our half hour. That was quick. A lot of Liz loans are variable rate loans with a swap. With interest rates, and we can talk about where you foresee interest rates going. Obviously, you don't have a crystal ball in front of you, but in the event of a default, how does Valley work with the borrower?
Look, I think to your point, derivatives are a good way to mitigate risk, interest rate risk in a high rate environment. And sometimes, depending where the difference between the Fed and the market can be a good way to take advantage of if the market is more bullish, than the Fed's. Even if you're in a problem where somebody's out of compliance because rates have gone up and it wasn't anticipated. Most banks, by the way, stress test, so it doesn't happen all that often. I think we work with you. I mean, I think that here's the bottom line. Most things we can work through if there's good communication. I would say, to Erik's point earlier in the conversation, I can't stress it enough: communication, communication, communication. And I think we're all experienced professionals in the market. We're going to find out anyway. You might as be the first person to tell me. But you can restructure. We can get a slight pay down. We can work through it. Maybe we can look at expenses. We're looking at everything on a quarterly basis, so we can kind of track it and tweak it. And through communication, give somebody a little relief for a quarter or two while we're working it out.
Interest rates, obviously, without a crystal ball, where do you see them going?
I think, look, the market anticipates we have no crystal balls, but I think the market is anticipating at least 2 rate cuts. Everybody's aligned that they think that there'll be 2 rate cuts in the upcoming future.
And in terms of the HUD side, we do fixed rate, long-term 35-year loans at fixed rates, and which today are in the low 5% range. But just because they cut short-term rates, that doesn't necessarily mean that long-term rates go down as well. We've had an inverted yield curve for a while. I think that's going to stabilize, but or kind of get back to, you know, a more parallel yield curve. But you know, the last time the Feds cut the rates a couple of months ago, long-term rates went up. So, you know, obviously we're all hoping that rates come back down, but the days of 2% HUD loans are long gone.
Yeah. I think that's a great point. Typically, bridge loans are priced off of a SOFR basis, so it's floating, like a 1 month floating rate. So it's very short term in nature, and it adjusts based on where the market is, if it's floating, or you have a derivative in place.
Yeah, I
on it.
mean, there could be a time, you know, Liz has great bank pricing that her rates based on SOFR could be equal to HUD rates or even less.
Don't kid yourself. Typically, Eric's the best bet for long-term financing.
Well, I want to thank the two of you for making yourselves available. And for those people out there that have further questions, both Liz and Eric's phone numbers and emails are on our website. Please feel free to reach out to any of us if you have any further questions, and we much appreciate your time.